The global economy has always been shaped by energy, from coal fueling the Industrial Revolution to oil, defining the 20th century, and data centers powering the digital age. Every major economic transformation has been driven by a shift in how humanity produces, distributes, and consumes energy. As we move deeper into the 21st century, the world is entering another historic transition, one that could make energy the smartest investment of the next decade. Investors who understand this shift early may position themselves at the center of one of the most powerful wealth creation cycles in modern history. Energy is not just another sector of the economy. It is the foundation of all economic activity. Every factory, every hospital, every school, every smartphone, and every electric vehicle depends on reliable and affordable power. When energy prices rise, inflation often follows. When energy supply is disrupted, markets react immediately. When energy becomes cheaper and more efficient, productivity accelerates. This deep integration into every aspect of life makes energy uniquely positioned as both a defensive and growth-oriented investment. One of the strongest arguments for energy as a top investment over the next decade is the unprecedented global demand surge. The world population continues to grow. Urbanization is accelerating, and developing economies are expanding rapidly. Countries in Asia, Africa, and Latin America are industrializing at a pace that requires massive infrastructure build-out. As millions of people enter the middle class, demand for electricity, transportation, air conditioning, digital services, and manufactured goods rises dramatically. All of these require energy, often in enormous quantities. At the same time, the digital revolution is adding a new layer of demand that did not exist a decade ago. Artificial intelligence systems, cryptocurrency mining operations, cloud computing platforms, and hyperscale data centers consume vast amounts of electricity. Training advanced AI models requires enormous computational power, and that computational power requires reliable energy supply. As AI adoption spreads across industries from healthcare to finance to manufacturing, energy demand could increase in ways traditional forecasts may underestimate. The global economy has always been shaped by energy, from coal fueling the Industrial Revolution to oil, defining the 20th century, and data centers powering the digital age. Every major economic transformation has been driven by a shift in how humanity produces, distributes, and consumes energy. As we move deeper into the 21st century, the world is entering another historic transition, one that could make energy the smartest investment of the next decade. Investors who understand this shift early may position themselves at the center of one of the most powerful wealth creation cycles in modern history. Energy is not just another sector of the economy. It is the foundation of all economic activity. Every factory, every hospital, every school, every smartphone, and every electric vehicle depends on reliable and affordable power. When energy becomes cheaper and more efficient, productivity accelerates. One of the strongest arguments for energy as a top investment over the next decade is the unprecedented global demand surge. The world population continues to grow. Urbanization is accelerating, and developing economies are expanding rapidly. Countries in Asia, Africa, and Latin America are industrializing at a pace that requires massive infrastructure build-out. As millions of people enter the middle class, demand for electricity, transportation, air conditioning, digital services, and manufactured goods rises dramatically. All of these require energy, often in enormous quantities. At the same time, the digital revolution is adding a new layer of demand that did not exist a decade ago. Artificial intelligence systems, cryptocurrency mining operations, cloud computing platforms, and hyperscale data centers consume vast amounts of electricity. Training advanced AI models requires enormous computational power, and that computational power requires reliable energy supply. As AI adoption spreads across industries, from healthcare to finance to manufacturing, energy demand could increase in ways traditional forecasts may underestimate. Solar and wind have become dramatically cheaper over the past decade. Technological improvements and economies of scale have reduced costs to levels that compete with traditional fossil fuels in many regions. Investment capital is flowing into renewable infrastructure at record levels. However, the opportunity is not limited to renewables. Traditional energy sources such as oil and natural gas remain critical to global stability and economic growth. Despite aggressive climate goals, the world still depends heavily on fossil fuels for transportation, manufacturing, and power generation. Supply constraints, underinvestment in exploration, and geopolitical instability have created a complex supply-demand dynamic. When investment in fossil fuel production declines too quickly, while demand remains resilient, prices can spike. These price cycles can generate significant returns for energy producers. Additionally, emerging markets represent a particularly compelling opportunity. Many developing nations lack sufficient grid infrastructure and reliable electricity access. Expanding energy access is both an economic and humanitarian priority. Companies providing scalable, cost-effective solutions for these markets may benefit from strong growth trajectories. Energy storage deserves special attention. Intermittent, renewable sources like solar and wind require efficient storage systems to ensure reliability. Advances in lithium-ion batteries, solid-state batteries, and alternative storage technologies are unlocking new possibilities. As storage costs decline, renewable energy becomes more competitive and reliable. Companies operating in the storage ecosystem could become central players in the next energy wave. Policy frameworks are also accelerating the sector's momentum. Government incentives, tax credits, carbon pricing mechanisms, and clean energy mandates create financial support structures for investment. When policy aligns with technological innovation and capital availability, growth can accelerate rapidly. In conclusion, the case for energy as the smartest investment of the next decade rests on multiple reinforcing pillars: rising global demand, electrification, technological innovation, geopolitical priorities, infrastructure expansion, inflation resilience, and capital reallocation toward sustainability. Few sectors possess such a powerful combination of structural growth drivers and strategic importance. For investors willing to analyze trends carefully and diversify intelligently within the sector, energy may not just be an opportunity, it may define the next era of wealth creation. If the first phase of the next decade is defined by demand expansion, the second defining force will be artificial intelligence and digital infrastructure. AI is not simply a software breakthrough. It is an energy-intensive industrial transformation. Every AI model trained requires massive data processing power, and that power is fueled by electricity. Hyperscale data centers are being built at an unprecedented rate across North America, Europe, the Middle East, and Asia. These facilities consume as much electricity as small cities. As generative AI integrates into search engines, enterprise software, robotics, healthcare diagnostics, financial modeling, and defense systems, electricity demand could accelerate beyond historical trends. This structural shift makes reliable, scalable energy supply not just an economic issue, but a technological necessity. Major technology companies are already investing directly in energy projects to secure long-term supply. Long-term power purchase agreements for renewable energy are expanding rapidly. Some firms are even exploring investments in nuclear and advanced grid systems to ensure uninterrupted operations. When technology giants begin acting like energy investors, it signals how central power availability has become to economic competitiveness. This alignment between the technology and energy sectors creates a powerful multiplier effect for investment opportunities. At the same time, oil markets are entering a period of structural complexity. For years, underinvestment in exploration and production, driven partly by ESG pressures and partly by capital discipline, has reduced future supply growth potential. Energy projects often require years of development before production begins. If demand remains resilient while supply growth slows, the result can be price volatility and upward pressure on crude prices. Historically, such cycles have generated significant returns for well-positioned producers. The energy sector has repeatedly demonstrated its cyclical nature. But in the coming decade, cycles may be amplified by geopolitical tensions and policy shifts. Natural gas also occupies a strategic role in the transition. It is often described as a bridge fuel, providing lower carbon emissions compared to coal while supporting grid stability when renewable output fluctuates. Liquefied natural gas exports are expanding, enabling countries to diversify supply sources. Infrastructure investments in LNG terminals, pipelines, and storage facilities are increasing globally. For investors, natural gas producers, and infrastructure operators may offer exposure to both transitional energy demand and global trade growth. However, renewable growth alone cannot solve intermittency challenges. This is where energy storage becomes critical. Grid-scale battery installations are increasing rapidly, allowing excess solar and wind power to be stored and released when needed. The economics of storage are improving as battery technology advances. In addition, research into alternative storage solutions such as pumped hydro, compressed air energy storage, and hydrogen-based systems is expanding. Storage is not merely a supporting technology. It is a core enabler of renewable dominance. Hydrogen represents another potential breakthrough. Green hydrogen, produced using renewable electricity, could become a key solution for decarbonizing industries that are difficult to electrify directly, such as steel manufacturing, aviation, and heavy transportation. While the hydrogen economy remains in early stages, governments across Europe, Asia, and the Middle East are investing billions into pilot projects and infrastructure development. If hydrogen reaches cost competitiveness, it could unlock an entirely new energy ecosystem, creating opportunities across production, transportation, and end-use applications. Nuclear energy is also re-entering the conversation. Small modular reactors and next-generation nuclear designs promise safer, more flexible power generation, as concerns about grid reliability increase, especially with rising AI-driven electricity demand. Nuclear may regain strategic importance. Countries seeking carbon-free baseload power are reconsidering nuclear investments. Companies involved in advanced nuclear technologies could benefit from renewed political and financial support. Energy security remains one of the strongest macroeconomic drivers. Recent geopolitical events have demonstrated how quickly energy supply disruptions can destabilize economies. Countries are diversifying suppliers, investing in domestic production, and strengthening strategic reserves. Energy independence is no longer just a political slogan. It is an economic priority. This shift encourages domestic infrastructure development, exploration programs, and local manufacturing of renewable components. Emerging markets amplify the opportunity. Billions of people still lack consistent access to reliable electricity. Expanding grids, building distributed solar systems, and deploying microgrid solutions could unlock both economic development and investment growth. As urbanization accelerates, infrastructure expansion becomes unavoidable. Despite these tailwinds, risks must be acknowledged. Regulatory uncertainty, technological disruption, commodity price volatility, and geopolitical instability can impact returns. The energy sector has historically been sensitive to policy changes and macroeconomic cycles. However, diversification across subsectors, renewables, traditional fuels, storage infrastructure, and technology can mitigate concentrated risk. The next decade may not be about choosing between old and new energy. Instead, it may be about recognizing that global demand growth requires expansion across multiple fronts simultaneously. Oil, gas, renewables, storage, nuclear, and emerging technologies may all play complementary roles in meeting rising global energy needs. Investors who approach the sector with a long-term perspective, balanced risk management, and strategic allocation may find that energy offers something rare: structural growth combined with essential necessity. Few industries possess such a powerful blend of demand, certainty, technological transformation, geopolitical relevance, and capital intensity. As the world electrifies, digitizes, and industrializes further, energy will remain at the core of progress. The question is not whether the world will need more energy. It is how that energy will be produced, stored, and distributed. Those who identify the right segments within this transformation may position themselves ahead of one of the defining investment cycles of the 21st century. As investors evaluate energy as a potential decade-defining opportunity, strategy becomes just as important as conviction. The energy sector is broad, complex, and highly diversified. It includes upstream exploration companies, midstream infrastructure operators, downstream refiners, renewable developers, equipment manufacturers, storage innovators, utilities, and emerging technology firms. A thoughtful investment approach requires understanding how each segment behaves under different economic conditions and how they complement one another within a balanced portfolio. One of the most effective long-term strategies is diversification across the energy value chain. The upstream oil and gas producers typically benefit most directly from rising commodity prices. Their revenues can expand rapidly during supply shortages or demand surges. However, they also face volatility when prices decline. Midstream infrastructure companies, such as pipeline and storage operators, often generate more stable cash flows through long-term contracts. Downstream refiners may benefit from margin expansion when crude input costs and fuel demand dynamics shift. By combining exposure across these segments, investors can reduce reliance on a single price variable. Dividend-oriented energy investments deserve particular attention. Many established energy companies distribute a significant portion of their free cash flow to shareholders through dividends and share buybacks. In an environment where income generation is increasingly valuable, these companies can offer attractive yield profiles. Infrastructure-focused firms, including certain utilities and energy transport companies, often operate under regulated frameworks or long-term agreements that provide predictable revenue streams. For investors seeking steady income alongside growth potential, these businesses may serve as portfolio anchors. At the same time, growth-oriented opportunities within renewable energy and energy technology can offer higher upside potential. Companies specializing in solar manufacturing, battery innovation, grid modernization, and hydrogen development may experience rapid expansion as adoption accelerates. These businesses may reinvest profits into scaling operations, prioritizing growth over dividends. While potentially more volatile, they can provide exposure to transformative trends shaping the future energy landscape. Another important consideration is technological convergence. Energy is increasingly intersecting with digital systems. Smart grids use real-time data to optimize distribution. Electric vehicles function as mobile storage units. Artificial intelligence optimizes drilling efficiency and predictive maintenance. Blockchain technologies are being tested for energy trading and carbon credit markets. This convergence blurs traditional sector boundaries, creating hybrid investment opportunities at the intersection of energy and technology. Capital allocation discipline within energy companies is also reshaping investor perception. In previous cycles, aggressive expansion often led to oversupply and collapsing prices. Today, many firms prioritize return on invested capital, cost efficiency, and shareholder returns. This shift may contribute to more sustainable profitability across cycles. Reduced capital expenditure in certain fossil fuel segments, combined with steady demand, can create tighter supply conditions, supporting pricing power. Environmental considerations remain central to the conversation. Climate policy, carbon pricing, and sustainability targets influence capital flows and corporate strategy. However, the transition itself requires massive investment. Building renewable capacity, electrifying transport, modernizing grids, and developing storage systems demand trillions of dollars globally. Rather than diminishing the investment case, environmental objectives may intensify it by accelerating capital deployment into energy infrastructure and innovation. Risk management remains essential. Commodity price swings can be sharp. Regulatory shifts can alter project economics. Technological breakthroughs can disrupt incumbents. Therefore, investors should evaluate balance sheets, cost structures, competitive positioning, and long-term demand outlooks before committing capital. Companies with strong financial discipline, diversified revenue streams, and adaptable strategies may be better positioned to navigate uncertainty. As we look toward the next decade, the defining question for investors is not simply where growth will occur, but where growth will be unavoidable. Energy stands apart because it is not dependent on trends, preferences, or consumer cycles. It is foundational, whether the world moves faster toward decarbonization or maintains a balanced mix of traditional and renewable resources. Energy demand continues to expand. Economic development, digital transformation, artificial intelligence, electrification of transport, and industrial growth all require one essential input: reliable power. The global energy transition is often described as a shift away from old systems toward new ones. In reality, it is a massive expansion layered on top of existing infrastructure. Oil and natural gas remain critical to transportation, petrochemicals, aviation, and heavy industry. At the same time, solar, wind, battery storage, hydrogen, and advanced nuclear technologies are scaling rapidly. Rather than replacing one system overnight, the world is building parallel capacity to meet rising demand while transforming how energy is generated. This dual expansion requires trillions of dollars in capital investment, making the sector one of the most capital-intensive and opportunity-rich arenas of the global economy. Over the next 10 years, several powerful themes are likely to shape returns. First, electrification will accelerate. Electric vehicles will continue gaining market share. Grids will expand, and industries will modernize equipment to run on electricity rather than direct fuel combustion. This shift increases overall electricity demand and drives investment in generation and transmission infrastructure. Companies positioned along this value chain, from utility operators to grid technology providers, may benefit from steady structural demand. When examining long-term megatrends, urbanization, population growth, industrial automation, artificial intelligence, electric mobility, and sustainability commitments, the common denominator is energy intensity. Even efficiency improvements, while reducing consumption per unit of output, are often offset by increased overall activity. Historically, periods of technological progress have led not to lower total energy demand, but to higher aggregate consumption. The next decade may therefore be characterized not by scarcity of opportunity, but by scale of transformation. Expanding renewable infrastructure, modernizing aging grids, strengthening energy security, electrifying transportation networks, and powering digital economies require unprecedented coordination between governments, corporations, and investors. Capital will flow where necessity meets growth, and energy sits precisely at that intersection. In evaluating whether energy could be the smartest investment of the next decade, the conclusion rests on a simple observation: no modern economy can function without it, and future economies will require even more of it. The sector combines structural growth drivers with tangible assets, cash flow potential, inflation resilience, and geopolitical relevance. Few other industries possess such a comprehensive alignment of long-term catalysts. Investors who approach the energy landscape with patience, discipline, and diversification may find themselves participating in one of the most significant economic shifts of the century. This is not merely about betting on oil, gas, or solar panels. It is about recognizing that the global system is being rewired, electrified, digitized, and modernized, and that energy is the current running through it all. The coming years will test markets with volatility, policy debates, technological disruption, and economic cycles. Yet beneath those fluctuations lies a constant truth: demand for energy will persist, evolve, and expand. Those who understand this dynamic and position themselves thoughtfully may discover that energy is not just another sector, it is the engine of the next decade's growth story. And in a world searching for durable, long-term opportunity, investing in the power that drives everything else may ultimately prove to be the smartest decision of all.